Hi, everyone. I'm Executive Editor Steve Ehrlich, and I'm here today with Willem Buiter. Willem is a longtime practitioner in the financial space. He was a member of the UK's MPC, which is basically their equivalent of the FOMC here. He's a former chief economist at Citi and has had a long distinguished career in the financial industry. So welcome, Willem.
Thank you. It's a pleasure.
Let's get right into it. You wrote an op-ed in the Financial Times a couple of weeks ago that really kind of caught my eye. And basically, the gist of it was that central banks should, quote unquote, get out of the gold game. You started it by pointing out, I guess, your belief that gold is in what you called, I believe, a 6,000-year bubble. And I think that's a great place to start. Can you just explain what you meant by that?
Gold is valued mostly for the belief that it is a good store of value. There's very few intrinsic services that it yields, either as a consumption good. Yes, I can hang jewelry around my neck, but much of the jewelry even is viewed as an investment rather than something done for its beauty itself. And of course, there's some uses in dentistry, some advanced technology may make use of gold, but it basically has very little intrinsic value. So this $4,000 plus value that we see today is that high simply because people believe it will be a valuable store of value. And these beliefs, self-fulfilling and incredibly fragile. It's very much like Bitcoin. Bitcoin actually has a proper use, if you want, as a means of payment, often for illegal transactions, of course, but that makes it desirable. Gold used to be, back in the Middle Ages and before, 3,000 years BC, viewed as a means of payment, a store of value. But nobody really these days exchanges gold when they go to the shop. So gold's value is what people think it will be. And that is an incredibly fragile support for the value of that intrinsically very low value commodity. And no central bank should, simply because historically we've had the gold standard, and the Mesopotamians used gold as a store of value and means of payment. You don't want to be a slave of history. We have alternative, superior means of payments and store of values, and central banks should hold their assets in a diversified portfolio of real and financial instruments. The US has more than 8 metric tons, the US government, in gold reserves, worth at current market prices over $1 trillion. This is completely insane. It's a very risky bet. They should get rid of the gold, sell it to people that can afford to lose the value that they buy. And you don't want to sell it to people who are financially fragile, but you sell it to the speculators who believe it will go up and can survive financially if it doesn't, and you invest the $1 trillion in a diversified portfolio of financial real assets, which protects the taxpayer.
Okay, so a few things to unpack there. I know some of the crypto people listening here will love one of the things that you said and will strongly disagree with one of the things that. I'll begin with the latter, the statement that most Bitcoin payments are used for illicit purposes. We could have an entire other conversation. I've had plenty with data pushing back on that statement. That's not what we're going to do here, though. But the idea that Bitcoin has more intrinsic value than gold, I know the industry will love. But let's just unpack what you said a little bit more here. I mean, gold is in a 6,000-year bubble, and in a way, that sometimes could almost seem like an oxymoron a bit to me, because bubbles just don't last that long. I mean, there may be boom and bust cycles over the years. I mean, like tulip bulbs, the South Sea, railroads in the U.S. The list goes on and on and on. Gold, though, keeps going up through millennia. And how does that square with your? It might only be worth what people are willing to pay.
Gold has been a very risky commodity in the past. Remember, when we had the gold standard, in the 30s, 40s, and all that, gold was priced at $35 a fine ounce, right? And before we got the gold standard, gold prices in the 16th, 17th century were significantly higher than that. So bubbles can last forever. They have ups and they have downs. And so gold will probably go on as a bubble for another 6,000 years. But the willingness of people to hold something simply because they believe many other people, including central banks, will view it as a valuable investment instrument, reliable store of value with very much upside and very little downside. No, that makes no sense at
So
all.
let's get to it then. I mean, if say the U.S. sells its trillions in gold, what should they buy? You said a diversified portfolio, I guess various stocks and commodities. Should they just purchase diversified index funds? Is there a case to put some Bitcoin on the central bank balance sheet?
I myself consider Bitcoin to be extremely risky investment. And I don't think that even in a diversified portfolio, central banks should invest in it. Central banks can afford the loss if the price of Bitcoin were to go to zero, even. But this is not something that I think should be part of a well-structured portfolio. The portfolio of the central bank could include exchange-traded funds, holding commodities, stocks, shares, and other financial instruments. So it should just be diversified and without any crazy exposures like gold and Bitcoin.
Let's just talk a little more about the world we live in today. The debasement trade is sort of all the rage. I mean, fears. I mean, the U.S. dollar I think is down 11% or so far this year. It's had one of its worst starts to the year in decades. There's easing pressure all across the UK, Eurozone, and in some circles there is a fear that we might be seeing a transition away from the dollarized economy. And in this period of inflation, that's where people are. That's why people are running to gold. Where do you see the current cycle with relation to gold, and with central banks continuing to acquire it? Should they sell it right away? Is there more room to run before they do so?
What is interesting about this debasement game is that in the past, doubts about the security of the dollar led to flight into other currencies. The euro, sterling, the yen. Now, of course, the renminbi or yuan. But this particular depreciation of the dollar has been not quite matched, but has been not that much larger than the weakening of other leading currencies. People have doubts about either the credit worthiness or the inflationary debasement that will come in countries with unsustainable fiscal situations. The US is one of them, but so is the UK, so is Japan, so are most advanced economies. Even China, when you add in local government and all that, has potentially material public debt challenge, which could lead to inflation. In some cases, when the US, if Congress were to fail for, I think, for the to raise the debt ceiling in time, you could even have a technical default. So you want to be out of that. So the flight into gold is really a goodbye to all leading currencies. The reserve state of the dollar is threatened, but so is the reserve status of most other rival currencies. But I hope and I expect that some fiscal adjustment, fiscal consolidation will, in not too distant future, begin in all countries that need it badly. And so while I think an inflationary outcome is definite risk for the US, for the euro, for the UK, for Japan. I think it is probably, even if I were to materialize, I wouldn't want to be in gold. I would want to be in a diversified portfolio of real assets or index-linked instruments for that matter. If the only fear is inflation, which of course you can cover with index-linked instruments, and not default, which of course would affect index-linked instruments as well. So even if you are convinced that the dollar will shrink in significance as a reserve currency and as a means of payment for cross-border transactions, there's still the alternative investment would be a diversified portfolio of real assets, not a single highly risky commodity like
And when
gold.
you say, real quick, when you say real assets, I mean, you're talking about stocks, I mean, companies that earn revenues, and then also certain commodities as well.
You could have commodities in an ETF of, of a wide range of commodities, including, if they were to be traded, claims on rare earth.
I'm sure there's somebody working on that. We need to take a very quick break to hear from one of our sponsors, and then we're going to be right back and talk some more.
Binance is the world's #1 crypto exchange, trusted by over 290 million users. With industry-leading liquidity, security, and a wide range of digital asset products, Binance is the place to buy, sell, trade, and earn crypto. Download Binance today to get started.
All right. So one of the things I appreciated about the article and our discussions, even before this interview, is your openness to Bitcoin and the understanding that it's meant to be a payment system. I want to get your thoughts on how that dovetails in the way that it's actually used today, though. Obviously, it was created to be a peer-to-peer payment system, decentralized outside of I guess, the reach of any real government. But as I'm sure you're well aware, today the mantra is HODL, hold on for dear life. Michael Saylor, the personality behind strategy, frequently says, don't sell your Bitcoin under any circumstances. And with supply, the emissions rates continuing to drop, the actual velocity of Bitcoin is falling. What is your sense of that? And then, like, what might need to happen for Bitcoin, regardless of whether or not it goes on a central bank balance sheet, to become have more of an economy behind it? Either talking about just payments or an emerging trend of what we call like BTC or like decentralized finance involving Bitcoin.
I don't think that Bitcoin as a private um, fiduciary digital instrument without anything backing it other than the belief that it has value is desirable store of value or means of payment. It's way too volatile. So I'm a great believer in the future of blockchain-based payment instruments, stablecoins, but they have to be fully backed by either central bank reserves or by claims on short duration treasury debt. And so Bitcoin simply doesn't meet the criteria. There's also, of course, the point which I think never gets mentioned, but that while Bitcoin, the total stock is limited at 20 million units, right? That's why the issuance goes down. There is no reason why we could not simply introduce Bitcoin 2, exactly the same program, or Bitcoin 3, 4, 5, 6, and 7, right? And if people believe that the new Bitcoin is as good as the old Bitcoin, then it would be a massive increase in the aggregate stock of many Bitcoins. So the fact that Bitcoin is capped doesn't mean that you cannot create basically identical financial instruments at
Well,
will.
one thing I would say to that effect is that, I mean, there must be tens, hundreds, thousands of Bitcoin clones, Bitcoin derivatives. There's various because all the code, as you mentioned, is open source. It's freely available. I could create Steve Coin that has the same emission schedule. You could create Willem Coin, but sort of the community surrounding Bitcoin and the that the hash rate, the computing power that helps secure the network, all of that has proven to be an insurmountable sort of moat against any potential copycats from trying to sort of steal mindshare directly away from Bitcoin. So I mean, I've heard that retort that you've mentioned, that people could just create more despite this hard cap limit. But for what it's worth, it really appears that everyone, governments, companies, individuals, like, they agree that there is a Bitcoin, and then like there are other Bitcoin type products that might try to go after a different use case, but those are not seen as substitutes in the minds of most.
But they are not seen as substitutes because they are not seen as substitutes. If they were seen as substitutes, they would be. So these things are, again, totally mindset-driven valuations. There's nothing intrinsic in Bitcoin that makes it unique or irreproducible. So at some point, and maybe not for a century, no, people will think, why not? And the why not would directly affect the valuation of Bitcoin. But I think not limit this discussion to Bitcoin. Really think that stable coins are likely, properly backed, to be the financial interest of the future. And I want the authorities to be able to finally agree to interest being paid on stable coins, fully backed ones.
Yeah, I agree. And that's the next place I want to take the discussion, because I know one of the things I found really interesting when we spoke last week is that in the UK, I think there are movements to try to limit the amount of stable coins that people can hold. I know lobbyists in the United States on behalf of banks are trying to limit stablecoin usage because of fears of because it'll suck deposits and then potentially credit out of the banking system. And you pretty forcefully pushed back and said that was ridiculous. So maybe you could just expand on that.
There's no doubt that well-designed stablecoins, fully backed ones, paying interest would be competitive with bank deposits. I actually would require bank deposits to be fully backed by central bank reserves or short duration treasuries as well. Of course, they're not. We have this fractional reserve banking. But let's think that the way they would be. So we introduce the stable coins, they're technologically superior to bank deposits, and people switch to them. Banks lose deposits. That interferes with financial intermediation, yes, but it doesn't have to, because assume the stable coin now is fully backed by central bank deposits. The central bank has to do something with these additional reserves it's issuing. And it can simply put the money as long-term investments back in the bank, so they can go on the intermediation between private agents. They simply take the monetary function out of the banking system. And unless the banks were to create subsidiaries, legally distinct, which just issued stablecoins, fully backed by central bank reserves and short duration treasuries. So there's absolutely no fear of financial chaos, even if stablecoins were to cause the complete departure of bank deposits from the bank's balance sheet. The central bank and the government can always put it back in the banks if they think that intermediation through the banking sector remains important.
One of the questions I really wanted to ask you, and it kind of extends from what you just spoke about. I mean, there's been a few different ways of creating like a blockchain-based currency, and you've mentioned each of them. I mean, one, the traditional like fully reserved one-to-one stablecoin, either backed by dollar in a commercial bank, although I guess technically if those dollars are hypothecated, maybe it's not. Then there are tokenized deposits, which are not fully one-to-one backed. This is interesting, in fact, because our former employer, I worked at Citi for about a year as well, Jane Fraser, the current CEO. Citi is experimenting right now with stablecoins, while Jane Fraser actually said, I think last week, that she thinks tokenized deposits are a better way to go. JP Morgan's also experimenting with tokenized deposits on blockchain by Coinbase. And then you mentioned like central bank digital currencies. As I'm sure you know, those have fallen into disrepute, especially here in the United States, where there's even talk of bills banning the idea of a central bank digital currency because of fears over privacy. Maybe you could just, I'd love to get your thoughts on just those three different categories. Like what are the pros and cons of each? And then I want to get into privately issued stablecoins potentially paying yield, paying interest, because that's a very hot topic of discussion in the United States now.
Yeah. Tokenized deposits are basically partially backed stablecoins, right? They're on the blockchain, but they just treat it from a reserve backing requirement as central bank as commercial bank deposits. I consider that undesirable because in the partial backing of bank deposits today and tokenized bank deposits in the future means there's always a risk of bank runs. So we have to have deposit insurance, and we have to have the central bank to stand ready to act as a lender of last resort. These two major and I would say financially unfair sources of support for financial support for the banks then are matched by tighter regulations on the to make sure that banks don't go crazy because the deposits are insured and the last resort is there. But so this we can do away with both deposit insurance and with the need for the central bank to act as a lender of last resort in the case of bank runs, and with the restrictive and costly regulations of banks that sort of that are the other side of the equation, and simply have fully backed bank deposits on the blockchain, preferably in a legally distinct unit to the bank, and that means they would be stable coins. Well, partially backed stable coins are simply a way, since they would be covered presumably by deposit insurance and lenders last resort facilities, they're simply a way of giving a financial edge to the banks at a cost ultimately borne by the taxpayer. So it's undesirable. CBDC, central bank digital currencies, I think are desirable. One reason is that if you make them not easily available on chain and off chain, for you have a CBDC card that you can waive and make payments with. So retail availability on, as I said, on chain and off chain, and you also no restrictions on the size of the account or the transactions, and you allow them to pay interest, but they will be superior to coin currency, which could be abolished, which would have the advantage of eliminating the lower bound on interest rates. Central banks cannot set interest rates meaningfully below zero because the zero interest rate on currency, on paper currency, effectively sets a floor. And so in the following the great financial crisis in the teens of this and following the COVID crisis, we should have been able, as a central bank, to set the interest rate, the bank rate, at -3 or -4%. Couldn't do that. So we had to do crazy things, like expanding the balance sheet by trillions, encouraging financial excess and speculation. So I think CBDCs are an excellent idea. It would require doing away with currencies, and that means privacy goes away. But you couldn't have full privacy with CBDCs, but you could have the pseudonymity, right? That you could have the wallets holding the CBDC being covered by appropriate crypto protections. So you could still trace, of course, transactions, unless you get the Bitcoin, right? But you don't know who is the beneficial owner of the wallets that hold.
And I've spoken with congressmen and lawmakers more on the Democratic side because it's almost, it must be universal Republican opposition to the CBDC at this point in the U.S., where they espouse a lot of the same arguments that you just made. And sometimes, like I studied privacy law a prior life of mine, and I always laugh at how surveilled our financial system is already just by private banks that have to work with the government anyway. So the idea that CBDC is going to introduce this Orwellian, like dystopian society, I think sometimes people need to realize how we're already living so far, and truly cash is, I guess, the only real anonymous way of making payments. But yeah, I understand that. One question I do want to ask: there's a growing number of companies here in the U.S. that are trying to get Fed master accounts so they can interact directly with the central bank and not have to go through intermediaries. No one has been successful in getting one yet. A couple of people have gotten like the federal trust charters, but that's more for just paying, not taking deposits. And the Fed governor actually, I think last week, suggested the idea of sort of a type of Fed master light account to sort of not give full access to some of these crypto companies that like a JP Morgan or Wells Fargo gets, but let them help disintermediate themselves a little bit. What are your thoughts on crypto, let's say stablecoin issuers directly interacting with central banks, be it the Fed or perhaps like even the Bank of England?
No, that's exactly what I mean uh, by having a CBDC. That you and I and any corporation can have an account with the central bank, with the Fed, say in this area, or with another central bank. Yes, that's a CBDC is simply a stable coin issued by the central bank, right? So I think it's desirable. It's part of the retail CBDC. The wholesale includes commercial banks themselves. They, of course, have it already. But I would expand this to any legitimate, well, for first instance, as a domestic resident, but there's no reason in principle why foreign entities should also not be able to have an account with the central bank. Yeah, that would, of course, compete with private stablecoins, and which one you would use would depend on which one pays the better interest rates and which one is more efficient. I believe that progress in the speed, reliability of payments is likely to be greater in the private sector than in the central bank. So I think stable coins issued by private entities should still be able to compete with CBDC, which is available retail and wholesale.
What do you make of sort of like the growing trend? I mean, now that the Genius Act is passed here in the U.S., it became law to sort of set the rules for privately issued stablecoins. I mean, there's Circle, there's Tether, there's some like sort of, I don't know if algorithmic is the right term, but there's like things like Athena. But now we're talking about the banks. And some of the big box retailers like the Amazons, the Walmarts, they're kicking tires on their own stable coins. Who do you like? How many stable coins do you think like the world can support at scale? And like, who do you think wins? Like, do you think it's going to be a more neutral party whose only business is a stable coin, like a Circle or a Tether? Or is it a world where JP Morgan comes in and launches JPM coin and just dwarfs all of them? And or is it going to be incumbent upon the banks to kind of work together and create like a consortium where they have one stable coin that is fungible across all of their different entities?
Whether these stable coins are fungible is up to the issuers, right? At the moment, we can transact payments between persons having accounts with different banks, right? There is no reason, of course, that should not be the case. If they're fully backed by central bank money or short duration treasuries, then they should be, generally acceptable and interchangeable. Yes. Whether JP Morgan, assuming they have to abide by the same rules of having a fully backed stablecoin, no fractional reserve stablecoin here, right? So they work on the same terms as the Amazons of this world or whoever else wants to issue stablecoins. I think we could see quite a lot of stablecoins. Depends on the magnitude of the fixed cost of setting one up and making it operational for domestic and cross-border transactions, that I think these setup costs could be quite high. I mean, that not too many of them will arise, but that remains to be seen. Of course, the key here that the stable coins all be able to pay interest at will.
All right, so we need to take one more quick ad break, and then we'll start to wrap up with a couple of questions looking out.
Binance is the world's #1 crypto exchange, trusted by over 290 million users globally. With world-class liquidity, security, and a wide portfolio of digital asset products, Binance makes crypto easy for everyone. Whether you're new to crypto or a professional, Binance offers a simple user experience. Learn with Binance Academy, browse hundreds of tokens, and track your portfolio on an easy-to-use dashboard. For experienced users, Binance Pro provides industry-leading services and bespoke trading products. With some of the lowest fees and deepest liquidity in the market, it's no wonder over 290 million users choose Binance for everything crypto. Buy, sell, trade, earn, live crypto. Download Binance today and begin your journey into the future of finance. Disclaimer: Binance is not available in certain countries, including the US. Check its terms for more information. Binance.com/en/terms.
All right, so we're back. I want to ask you, there's a big FOMC meeting this week. Seems that to be a virtual certainty that there's going to be at least a 25.
Well, the rate cut, yes, 25
Yeah,
basis
I'm
points.
curious, like what are your expectations? And I want to get your assessment of the economy, because there's a lot of different opinions here. I mean, for one, if you're looking at the employment market, maybe there are some concerns, but overall, the economy seems healthy. So there are those that say it doesn't make sense to be cutting into a strong economy. What do you think?
It's most unfortunate that a number of public sector data on the real economy, labor market, production, are delayed because of the government shutdown. But inflation is still running at 3%, both headline and core, which is above target, unless the Fed is surreptitiously changing the actual target to 3%. And its behavior in the last year or two.
Do you think, I don't mean to interrupt, but do you think 3% might be the new neutral rate, or do you think we're
I hope not, but I think it is a risk. I expect a Fed rate cut with 99% probability. I'm against it. I don't think we should raise rates unless there's evidence that the real economy, especially the labor market, is weakening significantly. And I haven't seen that evidence. The US Treasury has a triple mandate, as you know: maximum employment, stable prices, and moderate long-term interest rates. Right? And at the moment, I think long-term interest rates are moderate, inflation is above target, and employment, as far as we can see, is still reasonably strong, although weakening. So, to me, the sensible course of action would be to wait, even to raise the policy rate by 25 basis points. The last cut was, I think, a mistake. But this central bank must either have a different objective for inflation or have a very different view of the transmission mechanism of monetary policy if they're going to cut, as they will, now and no doubt in the next two meetings as well.
It's also, I mean, it's hard to have this discussion and ignore just the immense amount of pressure being put on Jerome Powell and the Fed from Trump and the White House. I mean, he's talking about like 300% cuts. I mean, the Fed may have cut on its own last meeting, and it may have been planning to do it again here. But I mean, putting Stephen Moran on the FOMC, the expectations for who's going to replace Powell next year, it certainly seems like, I guess, like sort of like the long tenet of an independent Fed. I guess ever since like Nixon, that might be a little bit tenuous at this point. So I wonder how much that pressure. I mean, it's probably hard to insulate yourself from that type of pressure being put on by the White House.
Well, then we'll find out soon whether the president can fire members of the board of governors, right? When the courts rule on Cook's case, she was allowed to stay on while this dispute was pending. Clearly, if the interpretation of the president's ability to fire board members for cause means that they can be fired for whatever every reason the president wants, then independence would be gone. But Mirand, I don't know how independent he is. He kept his
Yeah, he had a job at the White House
at the Council of Economic Advisors. He just went on unpaid leave for 5 or 6 months, I think. About that was just very bad visuals, because you don't want somebody who has still got a job commitment with the federal government to be a board member. But Powell, when he ends his term as chair of the Fed, can stay, of course, as a member of the board until 28. So, and that means that the new governor cannot be somebody appointed instead of, if Powell stays on, as I hope he will. That, of course, there will be. And so for the time being, Trump doesn't have a majority of appointees among the 7 governors. And of course, the 12 presidents of the regional reserve banks, 5 of whom vote at any one time, cannot be sacked or appointed by the president. And they have to be approved, in fact, and can be fired by the board. So as long as Trump does not control the board, he doesn't control the FOMC. Now, would the pressure be so severe that board members would cut rates easy as they think this is not compatible really with the mandate? I doubt it. I don't think we're there yet. I just think that the Fed is wrong, but not that they've lost their independence.
Okay. All right, great. Well, that's all I had. Do you have any final thoughts, anything you'd like to say to wrap up our discussion?
Not really. I think that we have to not give up, despite the political opposition in Washington and elsewhere, on retail and wholesale central bank digital currencies, on fully backed stablecoins that pay interest, and on enormous future, I see, for tokenized assets traded on the blockchain, both domestically and cross-border. We're going to have many more participants, potentially, in financial markets than we had as a result of this new decentralized finance world. That creates new risks as well, because some of the new investors will be deeply ignorant, and the tokenized assets are just as risky as assets bought and sold clumsily using conventional means of payment. But I do think that the web and the distributed ledgers can really help to democratize finance.
All right, great. Well, thank you so much for joining us. We'll have to have you back.
Right.